Investors are starting to panic, markets are shaky, inflation is unpredictable, and recession fears are creeping back. Is the economy on the brink of another major downturn? In this video, we'll break down the warning signs, what top analysts are saying, and what it all means for your money. BlackRock CEO Larry Fink, a man who knows a thing or two about markets, says he hasn't seen anxiety this high in a long time. This sentiment is echoed by financial advisors across the board. Their clients are worried, and frankly, they have every right to be. The economy is in a strange place. We're seeing growth, but it's sluggish. Inflation is lurking, and the threat of a trade war looms large. It's enough to make even the most seasoned investor sweat. The uncertainty is palpable. No one knows what the future holds, and that's what's really spooking the markets. This isn't just about numbers on a screen. This is about people's livelihoods, their retirements, their dreams. When the market gets jittery, it's not just Wall Street that feels the pain, it's Main Street too. And that's what makes this current wave of anxiety so concerning. We need to get a grip on this situation and restore some confidence in the economy. One of the biggest factors contributing to this anxiety is the unpredictable trade environment. Former President Trump's tariff policies continue to cast a long shadow. Remember those tariffs? They're back to haunt us. They were like a wrecking ball, smashing through global supply chains and driving up costs for businesses. These tariffs weren't just aimed at China either. Trump slapped them on allies like Canada and Mexico too. The auto industry in particular has been hit hard. Those 25% tariffs on imported car parts have really squeezed manufacturers, and who ends up paying the price? Consumers, of course. The tariffs have created a level of uncertainty that's poisonous for businesses. How can you plan for the future when you don't know what the cost of your raw materials will be next week? It's a recipe for disaster. And let's not forget the impact on global trade. These tariffs have sparked retaliation from other countries, further disrupting the flow of goods and services. The markets have been on a wild ride lately, and the tariff drama is a big reason why. Every time there's a new trade war headline, the markets freak out. Stocks plunge, investors hit the sell button, and fear takes hold. It's enough to make your head spin. Just look at what happened on March 31st. The S&P 500 dropped 0.75%, the Nasdaq Composite fell 1.82%, and stock futures tanked. Why? Because investors were worried about the ongoing trade talks. It was a classic case of risk-off trading. When uncertainty spikes, investors run for cover. But it's not all doom and gloom. The markets have also shown signs of resilience. After the Federal Reserve's March 19th meeting, where they signaled a more dovish stance on interest rates, stocks rallied. The S&P 500 jumped 1.08%, the Dow Jones climbed 0.92%, and the Nasdaq surged 1.41%. It was a reminder that the market can turn on a dime. The Federal Reserve, America's central bank, is walking a tightrope. They're trying to keep the economy growing without letting inflation get out of control. It's a delicate balancing act, and their every move is being scrutinized by investors. In their March 19th meeting, the Fed decided to hold interest rates steady. That was a relief to the markets, which had been bracing for a rate hike. The Fed also lowered their 2025 GDP growth forecast from 2.1% to 1.7%, citing tariff risks. However, they raised their inflation outlook to 2.8%. The Fed's dot plot, which shows where policymakers expect interest rates to go, now projects 2 rate cuts in 2025. This dovish tilt helped to calm the markets. Investors took it as a sign that the Fed is willing to support the economy if things start to slow down. Section 5. Recession clouds gather. Despite the Fed's best efforts, there are dark clouds gathering on the economic horizon. Wall Street is getting worried about a recession. Goldman Sachs, one of the most powerful banks in the world, has increased their recession probability estimate from 20% to 35%. Deutsche Bank is even more pessimistic, putting the odds of a recession at 50-50. These aren't just empty warnings. There are real signs that the economy is slowing down. Manufacturing activity is weakening, business investment is declining, and consumer confidence is shaky. The trade war is clearly taking its toll. Of course, recessions are a normal part of the economic cycle. But that doesn't make them any less painful. A recession would mean job losses, business closures, and a decline in living standards. It's no wonder investors are nervous. Section 6. Navigating the Storm Advisor Recommendations. So, what's an investor to do in these uncertain times? Well, panic is never the answer. Now is the time to stay calm, stick to your long-term plan, and seek professional advice. Financial advisors are urging their clients to stay the course and not make any rash decisions. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes such as stocks, bonds, and real estate. This will help to mitigate your risk. Focus on companies with strong fundamentals. Look for businesses with solid earnings growth, low debt levels, and a competitive advantage. These companies are more likely to weather an economic downturn. And remember, cash is king. Having a cash cushion will give you flexibility and peace of mind in case the market takes a turn for the worse. Section 7. Consumer Resilience, a Silver Lining. It's not all doom and gloom. There are some bright spots in the economy. Consumer spending, which accounts for about 70% of U.S. economic activity, remains strong. People are still shopping, dining out, and taking vacations. This suggests that the economy may be more resilient than some analysts fear. Bank of America CEO Brian Moynihan is optimistic, predicting that the U.S. economy could still grow by 2% this year. Consumer confidence surveys, while pessimistic, don't always tell the whole story. As long as consumers keep spending, the economy has a fighting chance. Of course, if the trade war escalates or the Fed makes a policy mistake, all bets are off. But for now, consumer spending is a reason for cautious optimism. Section 8. U.S. versus China, a tale of two economies. While the U.S. economy grapples with uncertainty, China's economy is booming. The MSCI China Index, which tracks Chinese stocks, is up a staggering 19% in 2025, its best start ever. Meanwhile, the S&P 500 entered correction territory for the first time since 2023. This divergence in economic performance is striking. Some analysts believe that Trump's trade policies have backfired, hurting the U.S. economy more than China's. China has been able to find new trading partners and diversify its economy. This is not to say that China doesn't have its own challenges. The country is grappling with rising debt levels and an aging population. But for now, China's economy is the envy of the world, while the U.S. faces growing uncertainty. Section 9. Expert Opinions, a Divided Outlook. So, what does the future hold for the U.S. economy? The truth is, no one knows for sure. Expert opinions are divided. Some economists believe that the U.S. economy is fundamentally sound and that the current slowdown is temporary. They argue that the trade war will eventually be resolved and that the Fed will continue to support growth. Others are more pessimistic. They worry that the trade war could escalate into a full-blown global recession. They also fear that the Fed has limited ammunition to fight the next downturn, given that interest rates are already low. The reality is that there are both risks and opportunities in the current economic environment. Investors need to be aware of the risks but also be open to the opportunities. By staying informed, diversified, and focused on the long term, investors can navigate these uncertain times and come out ahead. Remember, fortune favors the bold, but in these markets, caution is key. In the end, it's not about predicting the storm but learning to dance in the rain.